Hello my colleagues, welcome back to the channel, and if you are new here, you are absolutely welcome too. Now, you have probably seen the headline making rounds. CBN has mandated Nigerian banks to stop the payment of dividends. Well, in this video, I'll be breaking down exactly what is going on and more importantly, what it means for you as an investor. We'll talk about what is changing in 2025, which banks and sectors are most at risk, the ripple effect on Nigerian banks, how this could affect the Nigerian stock market and your portfolio, the broader implications for the Nigerian economy, and finally, what you should do in this kind of situation. Quick favor guys, before we dive in, please smash that like button so more people can see this breakdown. Share this video with someone or a community that needs to understand this. And if you're yet to subscribe to the channel, what are you waiting for? Please smash that subscribe button and turn on the notification bell so you don't miss timely videos like this. All right, without wasting any more time, let's jump right into the video. Let's go. All right, before we dive into the nitty-gritty, let's take a quick step back and try to understand what exactly is forbearance and why is everyone talking about it now. Well, back in 2020, when COVID hit and the Nigerian economy was on its knees, the Central Bank of Nigeria had to step in. They told the banks, look, we know many of your customers can't pay back their loans right now. Oil and gas companies, farmers, power sectors, and the rest. So don't stress yourself. You don't have to mark those loans as bad loans yet. That policy was called regulatory forbearance. It was basically like a soft filter on the bank's books. It made everything in the bank's financial statement look healthier than it actually was. The banks didn't have to set aside large provisions for these risky loans, and it gave them breathing space, which was fair at that time. But here's the thing, it's 2025 right now. COVID has come and gone, so that excuse doesn't hold anymore. And the CBN is now saying enough is enough. It's time to face reality. They are gradually removing that support system and telling the banks, start classifying those your loans properly. If it's risky, say it's risky. If the borrower is struggling, I want you to show it in your books. This is where the wahala started, because some of those loans are still shaky, especially in sectors like the oil and gas, agriculture, and the power sector. So in summary, forbearance was a lifeline during COVID, but now it's being pulled back and banks are being forced to deal with the real state of their loan books. So what exactly is changing in 2025? Well, the CBN didn't just wake up and say, let's stress the banks and investors, but they did drop a serious memo that is shaking things up right now. Here's what they are now telling the Nigerian banks, especially those that are still relying on forbearance. One is, no more delay in classifying bad loans. If a loan is shaky or risky, stop sugarcoating it, mark it properly. No more hiding under COVID policies. CBN wants banks to be honest and transparent about the quality of their loan books. No sweeping things under the rug. Secondly is no dividend payments. If your bank is still benefiting from this forbearance rule, you are not allowed to pay shareholders any dividends. That's actually very big, because dividends are one major way banks use to reward their investors. This hits both the bank and you, the investor. Then thirdly, we have no executive bonuses. Yeah, you heard that right. Top management in companies can't cash out either. If your bank hasn't sorted out its loan problem, then no end of the year bonus for Oga at the top. Then fourthly, we have no new offshore investments. CBN is also saying focus on your house first. No expanding abroad, no flexing in Ghana or London. Just clean your books at home here first. Now, this is serious. The tone from the CBN is clear. We have allowed you banks to breathe for years. Now it's time to face your real numbers. So banks that haven't been proactive will feel this pressure hard. And as you see shortly, the ripple effect don't stop with the banks. It touches we, the investors, stock prices, even the economy itself. Now, let's talk about who is sitting on the hot seat. Which banks are most exposed to this whole forbearance shakeup? Let's start with some numbers. The biggest exposures are sitting with the big boys. Zenith Bank, which has around 910 million US dollars worth of loans in this bad loan category. We also have FBN Holding, which has around 848 million USD. Then we have UBA Bank, 771 million. Then we also have the likes of Access Bank, Fidelity Bank. FCMB has some issues, but I heard that they are not really affected that much, and there are other companies or banks that are also following closely. But here's the twist: these loans haven't officially gone bad yet. They are what we call stage 2 loans under IFRS 9. That's the international accounting standard that bank use. Now, what does stage 2 mean? It simply means this loans hasn't defaulted yet, but the chances of it defaulting are very high. Maybe the borrower is already struggling, maybe cash flow is drying up, maybe the oil price hit them hard, but they haven't missed enough payments to be called a full-blown bad loan, aka NPL, non-performing loan. Think of stage 2 like a danger zone, and when a large part of your loan book is sitting in this stage 2 zone and the CBN is now forcing you to come clean, it becomes a real problem. You either have to start provisioning heavily, which eats into your profits, or start declaring some of these loans as non-performing, which hits investors' confidence and maybe affect your stock price. Now, I know some of you might be confused when I say the bank have to start provisioning and that it could eat into profits. Well, let me give you a very clear example of what I mean. Let's say a bank made 10 billion naira this year. That's their revenue. Out of that 10 billion naira, they have already spent 6 billion naira on salaries, or fixed expenses, marketing, and other day-to-day running costs. So they are left with 4 billion naira in what you would call pre-tax profit. Now remember, they have these stage 2 loans. Maybe borrowers are already struggling, cash flow is tight, and oil prices are affecting their borrowers. The borrower hasn't defaulted yet, but there is clear problem that is brewing up. At this point, the CBN is saying, oh yeah, don't hide these loans from your borrowers anymore. You need to be realistic. Start setting money aside just in case these your loans go bad. So the bank now has to take 2 billion naira from its 4 billion naira in pre-tax profit and stash it as a loan loss provision, basically an emergency fund in case things go south with their non-performing loans or their bad loans. That 2 billion naira they are stashing is treated like an expenses. So the bank's final profit drops from 4 billion naira down to 2 billion naira. So I hope that makes sense. That's what I mean when I say provisioning eats into profit. It doesn't necessarily mean they are spending the money now. It's more like they are admitting the risk that they have and bracing up for the impact. And if this keeps happening, especially across big banks, investors' confidence can shake, share prices may drop, and dividend payouts will get cut or be paused. That's why this whole issue is a big deal. And by the way, some banks are at more risk than others. All right, now let's talk about the ripple effect on the banks themselves. Now that the CBN is saying no more hiding, come clean on those risky loans, we are going to start seeing some cracks in the numbers, especially in two key areas. One is the capital adequacy ratios, or CAR. CAR is basically the bank's shock absorber. It tells us how much cushion a bank has in case things go south. But now with more loans being downgraded and provisioning rising, that cushion gets thinner, and when your CAR drops too lowly, it signals weakness. Regulators might step in, investors might panic. And two, we have NPL ratios, non-performing loan ratios. The CBN usually wants banks to keep their NPL below 5%. But guess what? With this new rule forcing banks to tell the truth about their loan books, some of them will cross that line. For example, FCMB might go from 5.4% to 7.2%, Zenith Bank from 4.6% to 6.7%. UBA and First Bank Holding are also expected to rise above that 5% danger zone. This stat is actually coming from Nairametrics. And once this actually comes to play, investors' confidence starts shaking. Shareholders begin to worry. Can this bank still pay dividends? Should I still even be holding this stock? Now, to be fair, not all banks are exposed equally. Some banks like Zenith and GTCO are in a much stronger position. They have already provisioned well and have strong buffers. But banks like FBN Holding and UBA, they did not provision so much, meaning they will either have to cut deeper into their profits or scramble to raise capital. And both of those scenarios don't look good for shareholders in the short term. So yeah, it's not just a headline. The pressure is real. Now, let's zoom out a bit and talk about how this is shaking up the stock market and you, the investor. Since the CBN made this announcement, we have already seen the value of some of these banking stocks drop drastically, as you can see on your screen. And it's not just individual banks. The banking sector as a whole has taken a hit. Well, why is this important? Well, first off, less dividends means less insensitive to hold banking stocks. Let's be honest, a lot of people hold stocks like UBA Bank, Zenith, GTCO, FBN Holding for the consistent dividend payout. Now, if that dividend is suddenly taken off the table, some investors will start thinking, why am I even holding this bank stock? And when people start dumping their shares, price falls. Now remember, the banking sector makes up a huge chunk of the NGX. So if this sector starts bleeding, it's not just the individual bank stocks that will be red. The overall market index could feel it. But that's not all. When sentiment weakens, smart investors start rotating their funds and into more stable ones, maybe consumer goods, industrial, or even telcos with strong fundamentals and clearer earning visibility. Even institutional investors, the big boys, might pause on new inflows into bank stocks for now. They'll want to see how deep this hole really goes before putting more money in. So yeah, this isn't just a banking story. This could start to affect your portfolio even if you don't directly own a bank stock. That's why it's important to stay alert and understand how money moves when confidence shakens. Now let's take it one step further, because this doesn't just stop at investors and stock prices. This kind of move by the CBN and the response from banks will definitely ripple through the Nigerian economy and real businesses. Here's how. You see, when banks are under pressure to clean up their books, what do? They tighten lending. They become more cautious. So now, if you're an SME trying to access a loan, or you're a big player in oil and gas, agriculture, or power, the banks might not be as friendly anymore. They will start asking more questions, requiring more collaterals, maybe even raising interest rates. In short, credit becomes harder to access. And what happens when businesses can't access credit? Growth slows down. A company that was planning to expand may hit a pause. Another that wanted to refinance an old loan might struggle to get favorable terms. And for sectors like agriculture or power that already runs on thin margins, this kind of lending freeze could choke activity. This is how a banking issue slowly becomes an economic issue. So while all of this sounds like bank talk, on the surface, the ripple effect could affect employment, sector growth, and even inflation, especially if supply chains are impacted. So after hearing this, you might be thinking, should I sell off all my banking stocks? Is this the beginning of a major crash? After all, the Nigerian market has been going up and up. You need to hold on a second. This is not the time to make panic moves. Here's what I want you to do instead. Start by assessing individual banks' fundamentals. Not all banks are actually affected equally. Some banks like Fidelity Bank actually appear to have moderate capacity to absorb this shock, thanks to their decent capital buffer and loan loss provisions. Yes, there are concerns about exposure to some vulnerable sectors, but overall, it's not a doom story. Others like Zenith and GTCO are also in strong positions. They have been proactive with provisioning and still maintain solid buffers. On the flip side, banks like FBN Holding and UBA might feel more pressure and will quickly need to act. So don't lump all banking sectors into one basket. Evaluate them one by one. Also, I cannot stress this enough. You need to diversify. Don't put all your capital in the banking sector. Look into telecoms, FMCG, industrial sector that aren't under much regulatory heat and may even benefit if money rotates out of the banking sector. And finally, you need to stay informed. CBN policy is something you can't afford to ignore anymore, especially if you are serious about investing in a country like Nigeria. That's why platforms like mine exist. I'll keep helping you understand the bigger picture and how it affects you as an investor. All right, my colleagues, that's the full breakdown. We have looked into what forbearance is, what's changing in 2025, who's most at risk, and how it affects the banks in the NGX, the broader economy, and most importantly, you as an investor. If you got value, do me a very solid one, guys. Like this video, it helps to push it to more people. Subscribe if you haven't already, so you never miss any update. And please share this video with someone or a community who are interested in this kind of topic or interested in finance and investing. And drop a comment below. I want to hear your thoughts on this new policy. Which stocks are you buying? What's, how you positioning your portfolio? I want to really understand the moves you are making personally. I'm also going to be commenting and replying all or most of the comments I get to see. And as always, thank you for watching, and until next time, Dewo.